Understanding financial markets, structure, functions, and importance. Financial markets play a central role in the modern economy, enabling the flow of capital and the efficient allocation of resources. They are platforms where financial instruments such as stocks, bonds, currencies, and derivatives are bought and sold. By connecting investors, lenders, borrowers, and businesses, financial markets facilitate economic growth, innovation, and wealth creation. This video explores the structure, types, functions, and significance of financial markets, as well as the challenges they face in an increasingly globalized and digital world. 1. What are financial markets? Financial markets are mechanisms or arenas where buyers and sellers trade financial assets. These assets include equities, stocks; debt instruments, bonds; currencies; derivatives, options, futures; commodities, e.g., gold, oil. Financial markets can be physical locations, such as stock exchanges, or virtual platforms, like electronic trading systems. They operate through regulated systems that ensure transparency, fairness, and efficiency in transactions. 2. Types of financial markets. A. Capital markets. These markets deal with long-term securities. Stock markets, where shares of publicly traded companies are issued and traded, e.g., NYSE, NASDAQ, London Stock Exchange. Bond markets, where governments and corporations issue debt to raise funds. B. Money markets. Short-term debt instruments, maturing in less than a year, are traded here. Examples include Treasury bills, T-bills; certificates of deposit, CDs; commercial paper. Money markets provide liquidity for governments and businesses to manage short-term obligations. C. Foreign exchange markets, Forex. The largest and most liquid financial market, where currencies are traded globally. It supports international trade and investment by enabling currency conversion. D. Derivatives markets. These markets trade financial instruments whose value is derived from underlying assets include futures contracts, options, swaps. Derivatives are used for hedging risk, speculation, and price discovery. E. Commodity markets. These include physical or virtual markets where raw or primary products are traded. Agricultural goods, wheat, corn. Energy, oil, natural gas. Precious metals, gold, silver. 3. Key participants in financial markets. Investors, individuals or institutions, like pension funds, mutual funds, seeking returns on capital. Borrowers, businesses and governments that need funding. Intermediaries, banks, brokers, investment firms that facilitate transactions. Regulatory bodies, ensure fair and orderly functioning, e.g., SEC in the US, FCA in the UK. Central banks, influence markets through monetary policy, e.g., interest rates, money supply. 4. Functions of financial markets. A. Capital allocation. They allocate capital from savers to users efficiently, ensuring funds are directed toward productive investments. B. Price discovery. Markets determine the fair value of financial assets through supply and demand dynamics. C. Liquidity provision. They provide investors the ability to buy or sell assets quickly without significantly affecting prices. D. Risk management. Derivatives and diversification allow investors and companies to manage financial risks, e.g., currency, interest rate, commodity price risks. E. Information dissemination. Markets collect and reflect information that influences investor decisions, promoting transparency and informed decision-making. 5. Importance of financial markets in the economy. Economic growth. Efficient markets fund business expansion and infrastructure, fostering innovation and job creation. Savings and investment. Offer individuals a place to save and invest for future needs, e.g., retirement. Government financing. Allow governments to fund public projects through bonds and securities. Global integration. Connect countries and economies, enabling cross-border investment and trade. 6. Regulation and oversight. Financial markets require strong regulation to maintain trust and stability. Regulators enforce laws to prevent fraud and manipulation, protect investors, ensure fair competition, maintain systemic stability. Examples of regulations: post-2008 financial crisis, global regulation tightened through reforms like Basel III, Dodd-Frank Act, and MiFID II. 7. Challenges facing financial markets. A. Market volatility. Caused by geopolitical tensions, economic shifts, or pandemics, e.g., COVID-19, volatility can erode investor confidence. B. Cybersecurity threats. Digital platforms are vulnerable to hacking and fraud. C. Regulatory arbitrage. Companies may exploit differences in regulations across jurisdictions. D. Systemic risk. Interconnectedness of financial institutions means that the failure of one can impact others, leading to broader crises. E. Ethical concerns. Insider trading, high-frequency trading, and lack of diversity in finance are ongoing ethical debates. 8. The future of financial markets. Financial markets are evolving due to technology and innovation. Fintech, mobile apps, robo-advisors, and blockchain are revolutionizing access and transaction speed. Decentralized finance, DeFi peer-to-peer financial systems using blockchain. Sustainable finance, growing emphasis on ESG, environmental, social, governance, investing. As financial markets become more global, digital, and complex, education, regulation, and adaptability are more critical than ever. Financial markets are the lifeblood of the global economy, enabling capital flow, investment, and economic development. By understanding their structure, functions, and the forces that drive them, individuals and institutions can make informed decisions and contribute to financial stability and prosperity. As they continue to evolve in the face of technological innovation and global challenges, financial markets will remain central to shaping the future of economies and societies worldwide. Thank you for watching.